Good afternoon, everyone, and welcome to the BizVal webinar. For those of you in South Africa, I think we've actually got registrants from 14 different countries, but for those of you in South Africa, you see my odd background. I'm not in my usual office. I've had to find a location that can take us through the load shedding schedules. So I think there are a few participants in that are probably also battling with the load shedding switchover. Firstly, for those of you who attended our previous webinar on the art and science of business valuations, welcome back. And for all the first-time visitors, thanks for joining us. We really appreciate having you here and look forward to engaging with you during the session. Today, we're going to be talking about how to go about building a more valuable business. I'm Graham Stephen, the co-founder and CEO of BizVal, and I'm joined today by my other two co-founders, the mystical finance ghost and the equally fascinating Howard Blake. For those of you who saw Tom Cruise in Top Gun Maverick at 60 years old, Howard is further proof that life really does begin at 60. So some quick housekeeping. There'll be a formal presentation section, which is going to last about 20 to 25 minutes. And that'll be followed by a further 20, 25 minutes of formal question and answers at the end. However, please feel free to send any questions via the chat as we're going along, anything that jumps to mind. The chat section is set to private, so only people who can see messages in the chat are the moderators and the presenters. The session will also be recorded, so if for whatever reason you need to drop off, it'll be made available on YouTube afterwards. Please feel free to share that with any of your friends, colleagues. We've also got a poll running, so if you look at the right-hand section of your screen, there's a poll running. So please click on the poll section during the podcast or during the webinar and record your response. So at our previous webinar, we discussed the basics regarding the art and science of valuations. The key talking points were around independence. So can a business operate without the owner or the founder? We'll be touching a little bit more on that today. We spoke about the importance of context and time in valuations, the impact of the economic environment, and the importance of cash flow and the quality of those cash flows. But today we're going to be focusing on the really juicy stuff. How do you build a more valuable business? So to kick off the conversation, I'd like to formally introduce you to our co-founder, Howard Blake. Howard is a serial entrepreneur. He's built more than 20 businesses over the last 40 years. And he's going to start by just sharing a few of his nuggets of wisdom on how to go about building and increasing the value of your business. So without any further ado, I'm going to hand over to Howard. Howard?
Thank you, Graham. And it's good to finally be able to speak with all those people who registered on the webinar. It's always nice to share experience. I think it's the one thing, as you get a bit older, you realize it's the one thing that you can share with people is often the things I've learned the most from are the mistakes I've made, and they always last with you forever. And being an entrepreneur, it was no mystery how I became one. It was out of desperation. I was a lawyer and left the practice that I was in to go into business when I had two young kids and a family to feed. So unfortunately, there's no Elon Musk story with any romanticism attached. It was just born out of absolute necessity. And over the next 32 years from that date onwards, I would have built on more than 24 startups. So just so that you know, I'm not an enterprise level corporate guy, I'm a startup guy. And a lot of my stuff has been focused in the tech sector and services as opposed to product. So that just gives you some background. And I think anybody who is familiar with business and has started a business of their own understands more than anything, the longest journey you're ever going to embark on in life has to be from when you have the light bulb moment, the big idea, to when the first dollar hits the bank in terms of revenue. That is the longest walk that you'll go on and the hardest one. And once you bank $1, there's no reason why you can't bank $1 billion. So once one's in the bank, you've got a formula and off you go. Thereafter kicks in what I refer to as the entrepreneur's frenzy. And that's the frenzy to get the business to at least break even. I didn't come from a background where I had the opportunity to be funded. So everything was bootstrapped, which I think is a great thing, because when you bootstrap a business, you tend to get to break even quicker than someone who's got a funding line. And as you embark on this process and you're trying to get your businesses going, get your revenue lines going, I think of the analogy of the frog and the princess, and as the story goes, you have to kiss a few frogs to find the princess, and it's no different with your revenue drivers. A lot of those revenue drivers are going to be frogs. You're going to kiss them and you ain't going to get a princess out of them. But the trick is to find the princess revenue line, the revenue driver that drives the critical growth into your business. And I think for an entrepreneur, this is often some of the hardest times, because you invite everybody to the party, and at some point you've got to say goodbye to a couple and start focusing. So these processes, when you decide which revenue driver is it that's going to build the most value in your business, is often where you need to get some outside direction, a sanity check by an external party, and get someone to help you. Now, I never had that, so I wish I did. And part of that was the passion about building BizVal. So while my two co-founders are the technical geniuses and the people that have put the algorithms, all the fancy things together, I was the guy who had the idea, because I wanted to relieve a pain point for entrepreneurs and business owners to demystify the valuation process. And I've been a client of the Big Four for many years, and I've had lots of valuations done at that level, and they not only are they extremely expensive, but sometimes they don't always relate directly to the private sector and private sector valuations. So for me, BizVal was a really personal project that alleviated a pain point of my own. And if I'd had that advice earlier on, and I was able to be critical about my own revenue drivers, and when I say revenue drivers, it's really looking at the value chain that you service and seeing how far can you mine that value chain to the left and the right, adding products or processes or services that then form the revenue drivers in your business. At that point, if you have direction and focus, you will build your enterprise value a lot quicker than if you just muddle through the process. And that's where I think something like business, I don't think, actually, no, that's why BizVal is such a valuable tool. That's why BizVal is an opportunity for us to be able to help absolutely everybody. And some of the products we will release later around playing scenarios, so being able to adjust certain scenarios and see how that affects value is a wonderful tool to be able to have and run different scenarios in building a business. Because in building a business, for anybody who has to focus on when it makes its first dollar in net profit, those are the critical moments. And getting there is a very interesting journey and can be a very arduous journey. So from my own perspective, this is very personal to me, because building those revenue drivers, and it's a process that never stops, building the revenue driver correctly links directly into your sales initiative. So once you've decided how you're adding value, how do you create more value? What processes and structures do you put in place to get more of that value in to make your enterprise value more substantial? And all of us want to increase the value of the things that we're driven in, but everything in the business, from the income statement right through to the sales cycle, is inextricably linked in the value build. And basically, that's why I'm passionate about it. Graham, back to you.
Great. Thank you, Howard. And yeah, as I said, guys, please feel free to add any comments or questions in the chat. If one or two of you could maybe just, I haven't had any comments come through yet. If somebody could maybe just pop a couple of questions into the chat so I can see that that is working properly. But thanks, Howard. I'm now going to hand over to the ghost. As you know, he's a bit of an enigma, so his camera is never on. But without any further ado, I'll hand over to the finance ghost.
Thank you, Graham. I don't have as much grey hair as Howard, but it's coming along, so I'll stick the camera off. It's the joy of being a cartoon. So welcome, everyone, to our second webinar. It's very good to have you here. So, before we go into more detail about how you build a more valuable business, I'm going to use my all-time favorite quote here. I was actually exposed to this quote with a YouTube video that someone shared with me probably at least 8 years ago now. And it was this, video about, doing what you were always born to do. And I think watching that video, I kind of made the decision that one day I would be an entrepreneur. And so here we are, So the quote's attributed to American football player Ray Lewis. I don't know a lot about NFL, other than I'm definitely not big or strong enough to play it, much like rugby. But I just love this quote, and it says, "Greatness is a lot of small things done well." And if you just consider what that means, It just means that doing something great is really about executing a lot of small initiatives to a really high standard. And that's all that a business actually is. An evaluation is just the outcome of all of these initiatives, rolled up into the business that you've built. There's no way for you to create value without just doing sensible things in your business, right? That make it better every day in every possible way you can. That's how you create value. It's a lot of small things done well. And in the first webinar, we touched on how the art and the science behind evaluation is complex, and it is complex. But today we'll be talking about some of the key drivers in evaluation. And to be honest, they are what you would probably expect them to be. If we leave aside the kind of macroeconomic inputs for a moment, the Fed will be telling us tonight whether it's 75 basis points or 100. The rest of the model is based on ultimately common sense. So that's part of what we'll talk about today. So if you're a dad like I am, or if you have little cousins or nephews or niece in the family, whatever the case may be, that picture will probably make you smile. That's a toddler fighting for independence on a mission down the road, almost certainly going to fall over, but that's how it works when you're a toddler. They have this inherent need to fight for independence. The instincts just kick in, and they know that if they don't become independent people, if it was a normal world in nature, they would have a big problem. And a business also needs to become independent, but unlike a toddler, a business doesn't know that. It doesn't instinctively fight you as the founder to become independent. In fact, it does the exact opposite. It's more like a really needy Labrador, right? The business just doesn't let you go. It doesn't let you go on holiday. It doesn't let you go away for the weekend. It doesn't let you switch your phone off or have dinner with your partner. Businesses don't know how to do that. They are the exact opposite of toddlers. And the problem is, if the business cannot exist without the founder, then it actually doesn't really have much value. And this is a tough pill to swallow. Trust me, I know. The Finance Ghost, my own ecosystem, is a perfect example. If I get hit by a bus tomorrow, it's worthless. It's literally worthless. That's how it works. So, I can't even at the moment disappear into the bush for a holiday for a month with no signal because it will make, very little revenue. So it's a lovely income and it's growing and it's doing all the right stuff. But right now, does the equity in the Finance Ghost have value? Not really. As I say, tough pill to swallow, but it's an important one. So the journey to creating value in the equity of a business is difficult, and it requires the fight for independence. You need to treat your business like that toddler and pretend it's fighting you all the time to get away from you. How do you do that? You bring in other people. You put in place processes and structures. You build a succession plan. This is a key area when you're doing a due diligence in any kind of private company deal. The valuation is just step one. Then you actually go and check out the business in detail and figure out that, what you put into the model is what's actually there. For example, one of the questions in our model is how many employees you have. Now, in our concierge model, which is something we've recently launched, and we'll probably talk about that at the end of the webinar, I'm sure. We've got a couple of other questions we ask at the moment to help us understand the level of independence that your business has from you. So if you are serious about selling your business one day, you have to treat it like you are raising a child who needs to go to university one day, leave the house, go off, get married, live their own lives. If you don't do that, it doesn't have value. Now, of course, that's only one part of it, right? The independence of the business. You need to ensure that the rest of the business is also as strong as possible. And there are a whole bunch of levers that you can pull to achieve that. You can focus on revenue, you can focus on gross margin, operating costs, working capital, the rest of the balance sheet, for example. But the reality is, if you don't have revenue, you've got nothing. So today, we're going to start there. In the world of startups, you'll hear a lot of terms like total addressable market and scale, right? You'll hear that all the time. Now, before you panic and think that this stuff is only for coffee shops in San Francisco, it's not. It's actually really applicable to any business, not just a tech firm. If you have a hair salon, it still applies. And that's a really important point. So some of the things you need to think about, some of what you need to ask yourself, how big can your business get? Realistically, how big can you get? So it doesn't help to own a hair salon and say, well, theoretically, I could cut every single person's hair in South Africa. Yes, in theory you could, but in practice, there's zero chance. No one has 100% market share except Eskom, and we know how that's working out. So you need to say to yourself, realistically, how big can you actually get? It's a lot easier to win in your own suburb and your own town where you understand the people, they like you, they know you live close by, everyone's very friendly. Try replicate that somewhere far away. It's not so easy. You can ask a whole bunch of listed companies about that. They've all tried to expand overseas, and often they come short. That's the problem. So you need to be realistic about how big can your business get, or if you are buying a business, how big can that business get realistically? Then you need to say to yourself, what differentiators do you have to enable the business to keep growing before the copycats arrive and they undercut you, which at some point they are going to, right? Without a strong differentiator, your growth rate over time is going to ultimately just revert to the growth rate of the industry that you serve. There is a reason why everyone is excited about Ferrari's new SUV that they don't want us to call an SUV. And it's going to cost an absolute fortune. And they will still sell out every single one 10 times over. There will be way more demand than supply. Versus Porsche's IPO that's just happened, or the prospectus just got released this week. You know, the Cayenne competes with the X5, competes with the Mercedes. It's way more of a competitive market, whereas the Ferrari just sits way further up. And all you need to go do is look at Ferrari's valuation multiples to understand the power of being differentiated. So if you are not differentiated, the best you'll be able to do is maybe maintain market share, but you're not going to grow it. The other thing you need to ask yourself is whether the market you are in is actually shrinking or growing. Now, if it's shrinking, how do you avoid shrinking with it? Can you keep winning market share? And how much longer will this market even be there for? Is there potentially an adjacent service offering available for you to try and mitigate that shrinkage? Something British American Tobacco is dealing with at the moment with people smoking versus what they call their sort of non-combustibles, which are still incredibly loss-making, the vaping devices, et cetera, but they are trying really hard to figure out a way to survive what is ultimately, in all likelihood, a sunset industry. So if you've ever heard the term moat before, this is a Benjamin Graham, Warren Buffett kind of concept. And ultimately, it just means investors look for businesses that have a defendable competitive advantage. So when doing evaluation, when building your own business, when looking at someone else's business, you need to look at how defendable that competitive advantage is and why. So the last slide I'm doing today is all about revenue quality. Now, if you've ever played Jenga, which is the game you'll see there on the slide, you'll know that the principle is you can remove actually a large number of blocks before the tower genuinely falls over. And I quite like that analogy and imagery because that tower is like a business. Like something's going to go wrong at some point, right? No matter how well you've built this thing, something's going to go wrong. Blocks are going to start to be taken away. If you haven't got enough blocks and you haven't put them in the right place, the tower collapses a lot faster than someone who's actually built that business with a really solid foundation. Now, with revenue as the lifeblood of the business, you know, that's where you see this play out the strongest. So this is where we talk about revenue quality, because two businesses might have the same revenue number, but actually the quality is very different, and that leads to a different valuation. So for example, what you really want to see is diversification in revenue. More blocks is always better. More customers, more geographies, more products, more sources of income. That's critical. So one of the questions in the model is customer concentration. You know, if you're very, very concentrated, your business is worth less than if you have a wide base of customers. That's why the world's technology giants trade at these eye-watering valuations, or at least they did until this year. And it's because they have this huge variety of clients who are typically paying annuity amounts and depend on that service for their own business, which is that point in the middle of the slide, annuity or contractual revenue. So to what extent, you know, is your revenue ad hoc? Do you have to fight for every single one? Or do you kind of wake up on the first of the month and you know, okay, this month I've already banked X amount. Everything over and above that is just a bonus, which is lovely. A cash conversion of revenue is also very important. If it doesn't land up in cash in your bank account, then it may as well have not happened. You know, Steinhoff Exhibit A. So obviously in listed companies that can play lots of games with financial reporting, it's a little bit different. Most private companies, typically the revenue is real in inverted commas. You do need to watch out in like some financial services companies, etc., where they're booking any kind of non-cash gains or anything like that. I mean, our tool assumes the revenue you give us is cash in nature. You will eventually collect it, but it also depends how long it takes to collect. And that's where the cash conversion comes in. You know, are you being paid effectively cash on delivery, or are you waiting 6 months to get paid? Because if you are, your revenue is not as valuable as someone who's getting paid cash. So the idea here is resilience. Revenue quality is all about resilience. How much can go wrong in your revenue base before your business actually falls over? So just to summarize the stuff that I've shared with you today in my section, the first thing, building a valuable business is about common sense. It's doing the stuff that you naturally want to do anyway to improve your company. Lots of small things done well. If you remember nothing else today, at least remember that. Secondly, the business needs to be a toddler. It isn't one. It's a Labrador. It never wants you to go on holiday and it never wants you to put your phone down. You need to fight that, and you need to help this thing become independent if you are going to truly create value in the business. Work yourself out of it. It's really important. And finally, revenue is obviously the initial and most important input in any valuation. And there's a lot to think about around that, with growth potential, the moat that protects your market position, and the quality of earnings, which ultimately makes your business more resilient.
Thank you, Ghost, and thanks, Howard, for those incredible and valuable insights. I'm sure you'll all appreciate, though, that in 20 minutes, we can only touch on the surface on some of the things that make a business more valuable. So I think we need to see today as a start of a conversation. In our next few webinars, we're going to be continuing the theme and exploring some of the other elements of building a more valuable business. So we plan on having a webinar once a month, either the second or third Wednesday or Thursday of a month. Please check out our website, where we'll advertise future webinars on LinkedIn and across our socials. So, if you're on this webinar, you've accepted GDPR, yes, we'll automatically get a reminder of our next webinars, but please, be aware of the future ones. So we'll be tackling topics such as, some of the more advanced topics like margin. How do you go about pricing? Unit economics, things like operating leverage. We spoke a bit about cash flow today, but the notion of cash flow versus accounting profit, the actual sales funnel, how do you grow your sales funnel, working capital management, long-term and short-term thinking. We'll go deeper in terms of succession and continuity. How do you do that? How do you build the processes, the structure, and the people to do that? And some of the unsexy stuff like financial planning and controls, and things like jurisdiction. So where you set up your business and why does that matter? Something like a tax haven, or people think it's great to set up in a tax haven. But if you're trying to sell a business that's in a grey list country, sometimes it's really hard if you're trying to get an international buyer. So we're going to go deeper into some of these topics and also into the how. How do you go about applying these learnings? So with that, I guess it brings us to the end of the presentation section of today's webinar. I'd like to leave you with this quote from Teddy Roosevelt. We must dare to be great, and we must realize that greatness is a fruit of toil and sacrifice and high courage. Building something is not easy. It requires hard work, it requires stamina, and it requires courage. And it's often easy to forget the sort of emotional side of building a business of value, or building something valuable. So what we're going to do now is we're going to be moving on to the Q&A section of our webinar. So we've got a few questions that have come through. If there's any other questions, please feel free to type them in the chat. After that, the recording will be made available. So without any further ado, in terms of the questions, I'm going to facilitate them. And I'm going to leave it to my two very esteemed colleagues to answer most of them. So let's start with the first question that's come through. It says industries use very theoretical models, free cash flow versus asset valuation, and then settle somewhere in between based on negotiation. Without the assets in many tech startups, how do we create these upper and lower boundaries? So I'm going to hand over to the Ghost. I think he's probably most appropriate to answer that question.
Yeah, thanks, Graham. Thanks for the question. It's a goodie. So look, all valuation models are theoretical models, right? I mean, that's what we covered in the first valuation, is there's art and science behind this. There's a theory, and then there's the sort of practical discussions and negotiations that take place. And you've highlighted two of the sort of three valuation multiple metrics, or kind of four, that the market tends to use. Free cash flow is one, sort of net asset value is another, then earnings multiples is a third one, and then depending on whether you have access to this kind of data, which in private companies is very difficult, you can look at examples of other transactions that have taken place in that market that you might be privy to and understand, what that valuation multiple was versus this one. And to your point, they sort of settle somewhere in the middle, typically based on negotiation, which is 100% right. So in tech startups, which don't have assets in the way that a factory would have, for example, like a manufacturing business, to create those upper and lower boundaries, look, for me, the discounted cash flow model remains kin. And we get these questions a lot. You know, people will say, well, how do you value the goodwill in my business? Well, if the goodwill is worth something, we'll see it in the cash flows. And if the goodwill isn't very valuable, then it's not going to come through in the cash flows. And then unfortunately, the goodwill might keep you warm and fuzzy at night, but someone else is probably not going to pay you for it. So discounted cash flows is where the magic is. And what we do in the model is we, based on the questions we ask, and obviously, you know, the model is designed to give a good answer at a very affordable price. So if you want to go and do the world's greatest 5-year plan and everything else, and then have that specifically modeled, you know, that's something we can do with you in the sort of concierge service that we run, which is still at a great price. It just requires a bit more of a high touch. But with the online model, you know, we model it out to 5 years based on the questions we ask. And the trick is to basically then use a high enough discount rate that you're applying enough of a risk factor to those cash flows. And this is especially true in a tech startup, right? Every tech entrepreneur is firmly of the view that their revenue profile is going to hockey stick. We've all seen those presentations. Don't worry, guys. I know the last year wasn't great, but next year this hockey stick is going to happen, and then it's straight to the moon, right? I'm being facetious, but I mean, we've all sat in those. We've all believed those at some point or another. And sometimes they happen, right? And sometimes they don't. And often what happens is it's somewhere in the middle. You know, it doesn't necessarily meet expectations, but it still does well. And that's where the risk weighting in the discounted cash flow comes into it, and the discount rate is very important. So creating upper and lower bounds, you know, in a tech business, you're never going to have a net asset value on it. It's basically the coffee machine in the office and the table tennis table that most of those businesses tend to own. That's all they've got. So that's useless. You've got to focus on discounted cash flow, very much focused on forward multiples and what will this business achieve rather than what it's achieving today. And then that tends to drive the negotiations. Howard, I don't know if there's anything you've experienced in practice that you want to add there.
Yeah, I have, and thanks for the opportunity. I think this is a very interesting question because I've done tech startups, quite a few of them. And what we've always tried to do is never attract anecdotal income, because I think it's the greatest temptation in a tech business is to take in everything anecdotal that arrives. So you want an annuity stream, you want to sell subscriptions as opposed to once-off services. You want to sell your services over a span of time and try to the best of your ability to make sure that the value proposition ties people into a duration of a relationship with duration that allows you to get them to subscribe to the service. Because I know I've sold one or two, and I learned my lesson very early on. I'll tell you what the immediate risk factors are. You get an indefinite period contract terminable on 30 days notice. It's worth nothing. That's a goodwill dream. You also sometimes have a whole lot of anecdotal income that has no tenure to it. So that's a challenge. In these tech startups, you want as much annuity-based income or a mechanism that shows that there is a continual flow through a process. Let me give you an example. Graham and I worked on an auction business a few years ago that we turned into an online digital offering. There you go. Add revenue drivers, add value that's outside of the traditional value. If they just waited for that auction to happen every month, that's all they would have had. But by adding a website and adding a digital interface that allows people to participate digitally, we created 2 additional revenue streams. And then all of a sudden, those monthly events become your annuity base, because the monthly events are definitely going to happen. You can track back over time that, say, $3 billion worth of property was moved on every auction, and they happen every 3 weeks, and you're able to track that. So that would be my advice. Get as much tenured income as you can, as opposed to anecdotal or service driven.
And that doesn't mean we're going to start charging for our monthly webinars. We intend that these will always be free. There's a question here from Robert, and I think it's leading on from the first question, Ghost, is traditional models of valuation miss tech blockbusters like Facebook or Google. How do we ensure that doesn't happen again? And a similar question that comes along is said, why are loss-making companies like Netflix and Tesla even perhaps so valuable? So maybe, Ghost, we can just talk a little bit about that. I think it's worth adding some flavor to
so
that.
the US market's a huge passion of mine. Anyone who follows me closely will know that. So, I mean, I love considering the valuations of those sort of businesses. And for me, the traditional models are not the problem. I think the problem is that when something is unproven, people are too bearish on it. And when something starts to show promise, they get way too excited. So back when Google and Facebook, it was hard to see what the future looked like. there was this naysaying of, oh no, that will just never happen, right? There's no chance that'll happen. Why would anyone do this? This is stupid. If you actually had the foresight to just be a bit more reasonable and say, well, what if it does? Let me model that out and put a big enough discount rate on it and see what that actually looks like. The traditional finance models would look after you in that scenario. You would still spit out a number and go, wow, this is actually worth a lot. Similarly, in the height of the pandemic, when everyone suddenly believed we would, for the rest of time, have dinner with our families over Zoom, the Zoom share price went absolutely bananas because it started to show promise. Traditional valuation models there, again, would not have necessarily been the reason it broke. People were just incorrect in their assumptions. So I think the key thing here is, garbage in, garbage out. Like with any scientific process, which is really what a valuation is, if you heavily underestimate the growth, you're going to underestimate the valuation. If you heavily overestimate what this business is going to do, then guess what? You're going to pay way too much. So for me, the models work. I think the problem is that as investors, we tend to have these biases of bearishness and bullishness at exactly the wrong time. And that's one of the biggest things to manage in portfolio management. And it comes through in valuations.
I think it's about, as you say, Ghost, about being robust in challenging your assumptions and expectations of growth and looking at that from a bunch of different angles. I think the next question from Zarush, and I guess this is probably, Howard, probably most relevant to you, but how do you best value the service segment of a business that's reliant on personnel or people, or perhaps Ghost, that's a question for you. And how do you lock in relationships with customers where you cannot legally contract them? So let's maybe tackle that as two separate questions.
I'll take the easy one. I'll take the first one, and then Howard can do the second one, which is much harder.
So that's where all the grey hair comes from.
So look, the first one, I mean, basically a business that's reliant on personnel is essentially a consulting firm, right? So, the Accentures of this world absolutely have value. Without a doubt they do. So as much as it's reliant on people, I mean, all businesses are reliant on people. I think the difference is how many of those people are just completely irreplaceable. And as a business gets bigger, the founder should, in theory, become a bit less important. That's why I still see Tesla as a startup, because what will Tesla be without Elon Musk? It's a very unique case. It's a big business, but without Musk, I'm not sure there's much going on there. Whereas, a lot of other tech startups or businesses have gone through that sort of leadership transition from the founder into a professional management team now. So what you look for in something like that, especially when you're looking in detail in due diligence, or, if we did a concierge model on that, you would look at stuff like the bench strength. How many people are actually in this business who are able to really pick it up and go? That's very important. What is the churn? How long have critical people actually been there for? I've been in a business with relatively high churn. It makes life difficult. You want to see people who've been there for a long time. It has more value. So it's almost an HR due diligence as much as anything else in arriving at the sort of multiples that you would look to pay for a business like that. Howard, I'll let you take the tough
I think
one
maybe
now.
to add to that, Ghost. Sorry, guys. To add to that is as you say, what are the processes I have in place to sort of train new people coming to the business in a consulting firm? What are they doing to increase their knowledge base? So as you rightly say, it's around that sort of HR due diligence, and what processes are in place to make people working in those businesses, whether it's a McKinsey or a Deloitte or one of the big professional services firms. If you look what they do to continually evolve and stay on the forefront of, let's call it, thought leadership, I think those are the kinds of things that you would look at. So I guess the next question, Howard, is how do you lock in relationships? As you said earlier, where there's no legal contract in place, particularly in the early days, and perhaps even when there is a legal contract, sometimes Howard's a lawyer by training, sometimes those legal contracts aren't worth the paper they're written on. How do you go about doing that? Howard, I think you're on mute. If you,
I really like both of Zarush's questions because they couldn't be more directly pointed at me if he had had a crystal ball. So, Zarush, the first question, if I can just add to Ghost's comments, so interesting. The services industry is a no-value business, fact. So, because you're rendering services when your customers no longer require the service, your value collapses, and any buyer knows that. And one of my first businesses, which are still trading today, is a contact center, and a contact center is exactly this: indefinite period, contracts based on 30 days notice on a service agreement that rely very heavily on personnel. So our current contact center staff complements over 3,000. And that's what makes this question really relevant to me, because I've taken a lot of beta discounts on this exact point. People would always say to us, why should we pay for your future contracts when your big clients can just cancel them on 30 days notice? The answer would be, well, they've been our clients for 30 years, so we don't care. Legally, they can walk away. How did we address that? We put software in place. We developed software in place that put some barbs on the hooks and doesn't make it that easy to walk. So our counter to that was introducing technology and process that made sure that the services we were rendering were so value rich that to be able to walk away from that would be a very difficult thing. And that's what ultimately gave us tenure. So you need to look at your service, the services that you are offering, and see, and in this world, the digital world, where we're able to offer so much in terms of value added processes through technology, I think it's opening up a whole new value proposition on the service segment where we won't get heavily discounted as anecdotal income, because our contracts can be terminated on 30 to 180 days. So I hope that gives you some insight on that. On your second question, how do you lock in the relationships with customers where you cannot legally contract with them? Again, you have to look at your value proposition. What is the depth of that value proposition? So if it's purely anecdotal, you're offering something where someone can just pop and use it and go away, then you can't lock that relationship, and it's physically impossible. It's purely discretionary. They arrive and use it and they depart. But if you look at the additional value that you can start to pack in around the service offering or the value proposition, that's where you start to introduce income tenure that allows you to build a relationship. In actual fact, you don't need to legally contract with them when you've built a dependency. I would much rather have a customer with dependency than a customer with a contract, because the person with dependency will always return, and a person with a contract will always look for somebody else to fulfill the contract at a better rate or a better service. So I hope that gives you some insight into those two questions, but thanks, they were great questions.
Great. There's a couple more questions. So we're calling last round. Interesting question from Khadas. It says, in a tech business, is it better in a valuation sense to own assets instead of renting, e.g. buy your office building instead of renting? And I guess that question could be applicable to any business, not just a tech business. So Ghost, perhaps you'd like to tackle that one.
Yes, I'm usually the wrong guy to ask about property, but I'll try and be as objective as I can on this one. No, so it comes down to capital allocation, right? You sit there as a business, you've got money on your balance sheet, and you have a variety of things you can do with it. And one of the options in front of you might be, hey, let's buy this office building that we're in. Now, right now, office property is awful. And what you want to do is be the tenant, not the landlord. Anyone from Growth Point will happily confirm that for you. So you can get really good leases at the moment. There's not much motivation to buy, I suppose, unless you can get it at an absolute steal. But then again, it all comes down to capital allocation, right? So typically at the moment, the yields on these office properties might be like 10%, for example. The only way that a property fund takes that 10% yield and turns it into a great overall return is by plugging in a monumental amount of debt. It's the same way we all buy our first house and usually the second and often the third. So for an operating business, you don't want to plug in necessarily tons and tons of debt and potentially put yourself under pressure just for the sake of owning your office building. You should probably have a better way to invest that capital, especially if you're sitting in a tech business. If you can't think of a better way to earn a yield than 10% on an office building, you've got much bigger problems than whether or not you should be buying the office building. You should be looking at this and going, okay, where is my growth going to come from? This thing seems very X growth. What do I do with it? So the exception is obviously where you have an absolutely critical retail site that you don't want to lose, or you have a critical warehouse, or you have a manufacturing property. I mean, that's completely different. To move your manufacturing is a big disaster. Just get your guys to pick their laptops up and go and plug in at home for a month and then come back to the next office these days is borderline a non-event. With hybrid working, it's happening already. And that's usually the case in tech. And the last comment I would make is, when you've got the cash in the business like that, if you don't have great ways to invest it, if you're starting to be tempted to do stuff like buying property in the business, it's actually better to rather just have the discipline to pay out dividends. Anyone coming into the business and looking at it as an investor is going to say, you know what, this is great capital allocation. When they don't have a use for the capital, give it back to shareholders. And one day when I'm a shareholder, that's what I'll want them to do. You could pay yourself a dividend, take that cash, go and invest it in a property fund on the JSE, get yourself the exact same yield with diversified exposure and liquid rather than owning one office building. So that would be my view on this.
Fantastic. Thank you, guys. I think we'll end with one final question. And it's almost looping back to the start of the conversation. It says, I know I need to be independent of the business, but where do I start? And I think I'm going to look to Howard, because he's been down this journey many times before. So, Howard, if you can tackle that, and then we'll wrap up.
Sure, Graham. Here's the thing to everyone listening. This question is extremely pertinent, and it's a very difficult one. So entrepreneurs, when their very nature, are the worst delegators in the world. Take Elon Musk as an example. He's always at the forefront of the brand and the business, and it doesn't matter what role he plays at the back. That's the way the public sees it, and that's kind of like what we like. We hang on to the things we feel that nobody else could do it better, and that's sort of the most fatal mistake. Because the first thing a buyer walks in and says, "How's your succession plan?" And then you look at them with absolute shock because you say, "How can you even suggest that?" So, in a way, they're contradictions of entrepreneurialism. Is very hard for us to hand over, but you absolutely have to. I've had to, and let me give you a rule of thumb. So in my case, when you hand over to somebody else, understand you're going to be getting 60% of what you're capable of doing. You've got to build that discount in. You've got to accept that. So it might well be that you might need to, if I look back on my experience, I would differentiate and I would build, I would have a look at different aspects, and I'd hand different aspects over to different skill sets. So let's say it's finance to a CFO, and it might be the sales function to a sales exec that you have to very carefully manage. In all those instances where I've done it, you don't get what you would have done. But if you hold hands through that process and you build that individual and you support them, over time, they will definitely get to 80 to 90% of what you were capable of doing, as hard as it is to admit. I think the challenges are holding someone's attention for that length of time and keeping them engaged and as excited as you will be. As an entrepreneur, you're always excited. They bury you. Still excited about all the businesses you started, all the businesses you're involved in. When you're an employee, you have your excitement is not quite to the same degree. So you have to realize that risk, and you have to compensate for it. So the compensation might well be that you diversify amongst 2 or 3 staff members, as opposed to expecting one person to be just like you, which would be a terrible mistake.
Great. Thanks, Howard. So I think hopefully you guys enjoyed the webinar. I think, as we put in the comments, if there's any questions, feedback, we really are here for you as owners, founders, entrepreneurs. So any topics or themes that you'd like us to tackle in future webinars, please drop us an email, visit us on our socials. We will get back to you on that. I think, as we mentioned a bit earlier, our next webinar will be going deeper. So it'll be a continuation of this theme around building a more valuable business. Please check out our website. We will be advertising this. If you've selected no to any of our privacy policy and you want to change that, please just send us an email, and we will, again, we'll put you on our mailing list. And then I think, just for the participation engagement, for us, this is great to engage with you, real people, take real questions and real answers. Thank you very much. We hope you enjoyed it. Maybe just a couple of closing words from the Ghost and Howard, and we look forward to seeing you in about a month's time.
Thanks, Graham. I'll go first. I'll let Howard close it up. So I think something I'm excited about is this concierge offering we've now brought in. So, we're a startup too, so we're learning as quickly as we can, and then we pivot when we get feedback. If I don't use that word, we don't count as a startup. So I have to find a way to use pivot in a sentence. So, what that means in practice is we've just launched something called the concierge offering. So what that means is, if you feel as though filling in the sort of online tool will either, potentially just be a bit tricky, even though we've tried to make it as simple as we can, or there are nuances to your business that you feel we need to know about in giving you the best possible valuation, then we've just introduced this offering. The cost is still very reasonable. It's more or less double the sort of online tool. So really, it's very manageable. And what you get then is you actually send us your financial details, and we will go and run the model for you. And then obviously there you have the benefit of both Graham and I running our eyes over it And actually, where we see an obvious tweak we need to the model, we'll do that. Where we see something we need to ask you, we'll do that too. And then actually send you a report. And if you've got any questions on it, we can obviously then try and answer them for you. So something I'm quite excited about. I've always been very passionate about bringing the skill set to entrepreneurs at a price they can actually afford, as opposed to a price that pays for fancy buildings. So, check it out. Let us know if it's something you're interested in. We've done a few of these concierges already. They've been incredibly interesting and really enjoy engaging with founders about what their businesses are actually worth, or at least what they seem to be worth.
Yeah, thank you, everyone. It's been great being able to share with you. And judging from the response we're getting on the message link here, or the chat link, thank you to everyone who's given us such lovely, encouraging words to help us continue with this project of ours. As Ghost said, we're a startup like everybody else, and we're also learning as we go along. But we think we've got enough collective experience to help guide other people along, and we know we can add a lot of value to that. So thank you once again for the opportunity.
Great, thank you, Howard. And I almost just tagging this on the end, the answer to our poll. Have you been involved in the sale or purchase of a business? Clearly, we're up against a tough audience here. 70% of people have answered yes. So thank you, guys, and have a great rest of the week, and we'll chat to you all soon.